What's going on, everybody? This is Simon from Netcon, and today I want to go over something known as a standard operating procedure, what it is, what it can be used for, and how I use certain standard operating procedures in trading, and go over an example of a standard operating procedure with you to pretty much give you an idea of, again, what those are and how you can use those to better your trading performance. So let's get started in the beginning. What is a standard operating procedure? So a standard operating procedure, also known as an SOP, is pretty much a guide or a checklist or certain criteria that you use to do a repetitive task. It doesn't have to be trading related. It could be anything from, waking up in the morning and going to sleep. Could be your morning and night routine. I have standard operating procedures for, how I go to sleep and how I wake up in the morning. For example, my standard operating procedure for waking up, hey, my alarm is ringing at 8 a.m. I get out of bed. I make my bed. I drink one glass of water. I take my morning supplements. Then I go weigh myself to know how much I weigh. I brush my teeth, etc., etc. And that is a process that is documented, and then I can repeat that exact same process. And why that is done is to eliminate decision making, because decision making, as you know, decision making is hard. Why make your life hard when there's a lot of things going on? So just to give you an example, let's picture a battery cell, right? Phones have battery cells, your brain has a battery cell, and when you wake up in the morning, you just woke up, your brain is operating at 100% capacity battery level, right? Let's say this is your battery. But every decision you make, you're pretty much draining that battery. Every decision you make throughout the day, what color clothes to put on, what color shoes to put on, am I going to eat eggs or am I going to eat sausage today in the morning? That is draining your battery. So what you have to understand is the more your battery gets drained, right, the harder it is for you to make decisions and execute fast. And this comes, obviously to trading, because as day traders, we want to be able to execute at really quick speeds and be able to process information extremely quickly. Now, I have standard operating procedures for trading, and I'm going to go over one of those with you, how it works, how I implement it, and why it helps me eliminate certain decision-making processes that I, usually do to help me execute faster and to also determine whether I should trade, sit on the sidelines, or get out, because sometimes, you're sitting in front of a computer for 1 hour, 2 hours, 3 hours, markets are open, and then there might not be a high probability trade during that time, but guess what? You still go in and you take a position, and then because you're bored, right, or you feel like, hey, I'm just sitting there for 3 hours, I need to take a trade, and then you end up walking out, negative $100, negative $400, whatever amount is, losing money for no reason when there was no high probability trade to trade. So this is, again, a standard operating procedure for entering trades, entering positions. Pretty much I go over this criteria. This is a criteria that I put together for myself. Again, this is for me personally. You can use what I use or adjust it for yourself. You can pretty much, again, use this to determine whether you should trade and what kind of trades you should take. So step number one, this is where we start. Entering trades, standard operating procedure. Number one, this is where we begin right over here. Has the market been open for at least 15 minutes? So between 9:30 a.m. and 9:45 a.m., there is a lot of chop in the markets. There's a lot of, messy action going on. And I like to have price action established the first 3 5-minute candles. That way I have clarity of where support is, where resistance is, and I can make certain trading decisions based off of that because I have previous information. If you're taking trades at 9:31, you don't really have any previous data to rely on to make certain high quality decisions for, stocks that are either breaking out, breaking down, whatever it might be. So I like to wait the first 15 minutes to take on trades. Now, again, if let's say I didn't have these rules, one day I might, trade at 9:43. One day I might trade at 9:31, and that way there is no consistency, right? There's no consistency what time I trade. There's no consistency what size I trade. etc., etc. Also, why 15 minutes? I track my statistics. So I tracked 400 plus trades using software that inputs your trades and gives you feedback. And I figured out that on pretty much 300 plus trades, right, I was losing money. The trades that were taking within the first 15 minutes, right? Out of, I believe, 300, trades, 313 trades were red, right? So out of 400 trades, 313 trades were red. What is this telling me? This is telling me that, hey, you suck trading the first 15 minutes of market open. This is backed by the statistics, right? The stats that I tracked on pretty much my performance. And that means that, hey, if I'm losing money 75% of the time or more, if I'm trading within the first 15 minutes of market open, that means I probably shouldn't be trading the first 15 minutes of market open, right? So I put this as my step number one. Has the market been open for at least 15 minutes? If it hasn't been open for at least 15 minutes, then I pretty much ignore this and I wait until the market is open for 15 minutes. If the market has been open for at least 15 minutes, I continue on to the next step, which is right over here, right? So that's going to take me to step number two. Step number two is saying, hey, do I have my critical level set for the stocks I'm planning to trade? Do I have support level set? Do I have resistance level set, for the stocks that I'm planning to trade? Because if I don't have a high probability setup whatsoever because I'm trading, without a plan. If I don't have those critical levels established, how am I supposed to trade? And a lot of people I know that rush and skip to, let's say, taking on a trade in step, 6 or 7 without having step 1 or 2, completed. If you don't have your critical level set, you should not be trading or taking on any positions, right? And again, so if I don't have my critical level set, I'm going to use this. So if I don't have, if I do not have my critical level set, right, I will set critical levels using top-down approach from 1 year, 1 day chart to 1 day, 1 minute chart. So I'm going to use a top-down approach and go from 1 year chart all the way to the 1 minute chart intraday, and I'm going to set my support levels and resistance levels, right? That way I have, again, data to base my trades off of. If I do have those levels set, right, if I do have support resistance set, my stocks are charted, great. I'm going to continue on to the next step, right? And then we come to here, step number 3. Do I have an understanding of why I'm trading this particular stock? This is pretty self-explanatory. Why are you trading the stock? Is there news? Is there a catalyst? Is there an upgrade or downgrade? Did Elon Musk tweet something about Tesla, or is there a catalyst that's going to potentially, make this stock in play, right? Make it so that the stock is going to have some sort of movement, whether it's on an upside or, the downside. Could be both. Could be a negative catalyst, could be, a positive catalyst. It doesn't really matter as long as I have an understanding, of why, am I taking this trade? Is there any news or catalysts that are making the stock move in a certain direction? This is super important because if you're trading stocks that don't have any news or catalysts, or are trading just random stocks, they are most likely not going to have high probability of moving and having volatility where they, make continuous moves where you can capitalize on those certain moves. You're just going to be, range bound where stocks are doing this for the entire day, and you're going to get burnt throughout this area right over here. And you don't want to do that because, again, you want to preserve your capital and you want to execute on high probability trades, and that wouldn't be a high probability trade. So if you do not have an understanding of why you were, trading a stock, do not trade it, right? Go back and understand, hey, is there any stocks that have news or catalysts that I can trade, or do I have an understanding of why I'm trading that certain stock, right? Once you do come to that understanding, you continue to the next step, which is over here. So next step following that is, is the overall market moving in the same direction as the stock I'm planning to trade? So for example, let's say I pick to trade stock Tesla, right? TSLA. I went through this procedure. It's after 9:45 a.m. I have my critical level set. I know why I'm trading the stock because let's say Elon Musk tweeted that, Elon, let's say tweets that stock Tesla is, for example, the company beat their deliveries. They delivered, 100,000 cars, and they were expected to deliver, 70,000 cars, right? This is a good news. This is a catalyst that can be used to drive Tesla price, up or down. Again, if this is a good catalyst, it will probably act as a catalyst, once again, to drive the stock price of Tesla. And there's pretty much a higher probability of Tesla having some sort of volatility or move. So now that I understand that, there is, let's say, a catalyst. So is there a catalyst, right? Check. Do I have my level set? Check. Is it past 9:45 a.m.? Check. Now we're here, is the overall market moving in the same direction as the stock? So what I mean by this is the SPY, the S&P 500, or the NASDAQ, right, /NQ, are those indices, are they moving in the same direction that the stock I am planning to trade? For example, Tesla has this beautiful catalyst. We're setting up, we're approaching resistance, right? And you think it's going to break. But guess what? If your Tesla is setting up nicely, but the overall market is selling off, guess what? There is a low probability of that Tesla trade that I just drew to break out and continue and have, more moves to the upside, just because the overall market is selling off right over here. So this is, would be considered a divergence, where your overall market is selling off, but a stock is, pushing up. Or it could be the other way around, where let's say the stock is selling off, but the overall market is pushing up. If there's a divergence of this sort, I would not be trading the stock, because again, this would be a low probability trade. Because if all stocks, are selling off, if tech is selling off, from NASDAQ, if SPY is selling off, why would I be looking for an upside play, right? Because it wouldn't be a high probability play. I'd be looking for downside plays because the overall market is selling off, not, so that's what I'd be looking for. So this is this step right over here. Is the overall market moving in the same direction? If not, then I would avoid this trade, because again, it will be low probability. If yes, then great. Look, if Tesla is setting up beautifully and you have, let's say a triangle formation, and Tesla is rallying up into the triangle like this, and then you're trying to catch a breakout right over here, and then the overall market, SPY, is also, pushing up, then this would be a higher probability trade to enter on this breakout, because, you have, the overall markets are pushing. Then you also have the catalyst, where let's say Elon Musk tweeted something, right? This is this step right over here, right? That is pretty much that step. So let's go over to the next step. Next step is, am I trading stocks or options? I personally scalp options, so this is just for options right over here, and I'm sure most of you trade options too. But if I'm trading options, do I know which contracts I'm selecting and why I'm trading those? Because sometimes what happens, and you probably have experienced this too, is you pick a contract, either a call or a put, right? The stock moves in that direction. Let's say Tesla moves $10 on downside. I was in puts, right? Yet my contracts either lose value, right? Either lose value, right? So you're negative money, or they don't do anything. They just stay flat. And you're like, hey, why is this happening? Why is Tesla, moving and my contract staying flat at zero? Or you're actually negative money, you're down, even though the stock moved in your direction. Because there's a lot of factors that play into options. There is, the Greeks, there is delta, vega, implied volatility, IV, theta, burn that comes into it. So understanding those Greeks, understanding what kind of contracts to choose, understanding how far, in the money or out of the money you should be going, is going to play a very, very crucial role in pretty much trading, right? If you don't have an understanding of that, then guess what? You're not going to have a high probability trade, because you might, catch a move on Tesla, but guess what? Your contracts are going to remain at the same price, and you don't want to do that. So my go-to rule for contracts is to make sure that they have at least 1,000 volume and 1,000 open interest. Let me try to show you right over here. Wouldn't let me log into TOS. That's okay. But on your options chain, make sure you have at least 1,000 volume and 1,000 open interest. Within first 10 minutes, I like to see 300 plus volume contracts. Obviously, your volume is going to be at 0 when the market opens at 9:30 a.m. But by about 9:40 a.m., right? So from 9:30 to 9:40, 10 minutes after markets open, I expect to see at least 300 volume on those contracts. And why that is because I want to see liquidity. What this means is that there has been, at least 1,000 contracts of those traded throughout that day, and that gives me insights that, hey, there's a lot of activity going, right? There's high activity in those options. That means it's going to be easy to get in and out of those options. So if I want to buy, if I'm a buyer or a seller, it's going to be easier for me to get into these, right? And the open interest just shows me how many people are there inside that position currently, how many contracts are open. If there's close to 0 or a low amount of contracts open, again, there's no liquidity. There's not a lot of people who are holding those contracts, and I want to follow the money. I want to see where retail traders are, where big money is sitting, and trade the same contracts a lot of people are trading. I don't want to be trading contracts with 0 open interest because I'm not going to be able to get out, right? And then once I develop an understanding, right, and pick the contracts for whatever reasons, right, whether, I understand that, hey, I want delta to be higher than theta for my contracts, or whatever the rules you have for your contracts, and you have an understanding, and let's say they have high volume and high probability, then you can go over to the next step, right? This one right over here. And this, again, is the next criteria. Once you determine that, you continue on to the next step. Does this underlying stock have above average volume trade on 1 and 5 minute charts? Volume supports price, guys. You want to trade stocks, again, I'm not saying you can't make money trading stocks with low volume, but it's all a probability game. Trading is all about probabilities, and you want to capitalize on trades where you have an edge. If you're trading trades with low probabilities, then you have low edge, and you would not be able to make money consistently with this. You might make money once or twice, get lucky, whatever, but you're not going to be able to sustain this for a long period of time. So if there's a low volume, volume is pretty much like effort. Buyers and sellers are showing you how much effort they can put into a stock. The higher the volume, the higher the effort. And if there's no effort, there's no result. Meaning, what I mean by this is if there's no high volume or high effort, right, for a stock, that means it's very unlikely that the stock is going to move fast or aggressive or a lot, right? So I want to see that, for a high probability trade, let's say we're going to take that Tesla example once again. We have a bull triangle setting up. We have Tesla going up. It's past 9:45 a.m., right? We understand we're trading Tesla. We understand that there's news and catalyst for that stock. Let's say Elon, tweets, right? Tweets. Let's say this is a $650 level for Tesla. I understand that I'm going to buy the breakout. We also have confluence from the markets. Overall, markets are pushing, SPY's pushing, NASDAQ is pushing. And now if you add volume candlesticks to that chart as well, guess what? Now you have an even higher probability of a successful trade, because guess what? You have all of these catalysts aligning all at once, right? And you're using them synergistically to enter a position. Do you think your probability is going to be higher or lower if you have all of these factors, all these checks aligning for a trade? Obviously, your probability is going to be higher for it to be a successful trade. And I would be using 1 and 5 minute candles to determine and see, hey, is there high volume or low volume? If I'm buying breakouts, if I'm buying stocks that I expect, bigger moves and volatility from, then I want to see above average volume on those candles. I want to see that, hey, this is breaking out and this is supported by volume, because I want to see that, hey, there is buyers, there's actual activity, and there is, effort being put into driving this stock up. If this stock breaks out on low volume, the same breakout that just happened, I am not trading this. I don't care if SPY is pushing. I don't care if Elon tweets. This has low volume. This should show me that this is probably not justified by buyers and sellers. There's no aggressive buyers trying to bring this stock up, so why am I buying it, right? There's no reason to buy. So once I figure that out, right, let's say I do understand that there's higher than average volume, I move on to the next step, I move on to the last step we have here, and that is determining the appropriate position sizing for that particular trade. Now, what do I mean by that is how much am I going to put into that trade based on my account size? My personal preference is I will never, and I mean never, those are my rules, trade more than 20% or O2 of my account size. So, for example, if my account is at $100,000, I will not put more than $20,000 in a trade. It doesn't matter if it's stocks, options, that's my rules, right? No matter how high the probability is. If it's low probability, I might put 10 or 5K into the trade, right? If it's high probability trade, based on those criteria, I might put in, let's say, 20K or go in with 20% of my account size, or I might scale in. I might put in first 5K. When I get more confirmation on trade, I'll put in 10K and then eventually scale in to 20K. But understanding your position size is really, really crucial for trading, obviously, because you want to maintain your position size consistent and you want to protect your downside. You don't want to expose yourself to so much risk, because if you go in, with 100K and you only have 100K in your account, and you take a 20% loss on option contracts, guess what? That 100K account just went to $80,000 and you just blew 20% of your entire account in one trade. That should never happen as a trader, right? Max loss for a single trade should be between 1 and 2% of your entire account size. Understanding that, if my account is at $100,000, right, and I take trades, and I trade, let's say, with $20,000, that means on a $20,000 position, my max loss is $2,000, because I don't want to lose more than 2% of my account, which would, if I did, would bring my account to $98,000. So I'm still okay to trade next day. I can still make mistakes, fuck up, and guess what? I'm still around that 100K cushion. One successful trade with a great risk-reward ratio will make that up for me. That being said, risk management is, again, key and crucial, and you need to understand position sizing. This is also going to contribute to your edge in being a high probability trade. Just let's say that I have all these boxes checked. I have news. I'm trading after 9:45. Elon tweeted. Markets are pushing. I know what contracts I'm selecting. There's volume. But guess what? If I size up incorrectly, and this last step is avoided, no matter what, that these first steps are ticking the boxes. This one didn't, so this is not a high probability trade. Guess what? All the factors can line up, yet I can still take a bad trade based on my position size and blow my account. Right? That is why it's important that all of these checklists are met before you enter a position. Once you check off all these things and they align, only then you can proceed to taking a trade and executing. So this is how I go about standard operating procedures, guys, how I would use this, and how I use this pretty much on a day-to-day basis. I still use this till today to make decision-making, process easier in my trading. So, when I trade, I always read through this and check one of these out. I print out about, 20 of these papers a week. And every single day, I pretty much take a new paper and I check off for every single trade all these things before I get into a trade and position. And I highly advise you do the same. Again, you can use these checklists that I use, or you can recreate it into your own checklists and a process criteria that you would be able to follow for your personal preference. Maybe you feel comfortable trading within the next first 15 minutes of market open. I don't know. That depends on your again, trading approach and trading style, what kind of instruments you trade, and many other factors. So you have to determine that for yourself. But yeah, guys, I'm going to attach this template that you see here in a Google Docs file that you can pretty much access and make a copy of, and pretty much use this right over here to make your own copy or download it and print it out, do whatever you want. So yeah, that is it, guys. That is how I use the standard operating procedure. And yeah, this is Simon again from Netcon Trading. Visit us at netcon.com if you guys want to sign up with us. If you're already a member at Netcon, really appreciate your support, and I hope you found this video valuable, and I will see you guys in the next one. Thank you so much, and I'll see you soon.